presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compact Market Wrap YouTube update for August the 19th, 2024. I'm Mo Ansari, President of Compact Asset Management and host of Market Wrap. Thank you so much for joining me today. And again, you can get all of the YouTube, the podcast, the weekly newsletter, and all of the events that we do around the country, the seminars, the webinars. All of that information is available. All of it is free. All you need to do is go to compact.com/media, compact.com/media, and you can get all of this information absolutely free. I know a lot of you have listened to Market Wrap for the last 35 years or so. I don't do the radio broadcast anymore. I've been told I need to catch up to the times and not do radio, but do podcasting. So we have the weekly podcast and this YouTube update just for you. Looking at the markets, one of the best weeks in the market, up 4% for the S&P, up 5.35% for NASDAQ, but the Russell was up 3%, but not as much, and that's the concern. It went down just like the S&P did, but it did not snap back up. And that's what we talked about on the podcast quite a bit. Javed mentioned that he wanted to see the pullback, and then he wanted to see the snapback before he got really sold on the Russell 2000. I still think that as interest rates come down, the Russell will do. The question is, will it do as much or better than the S&P? And that is still a question that has to be answered. Technology, again, led the way up last week with up 7.6% for the week. Tremendous week for snapback rally for technology. That's what we saw. Oil also was down a little bit and down big today, as there is talk that there might be some progress on the ceasefire in Gaza. And if that happens, that could be very, very good. 10-year Treasury down to 3.89. It's back up to just about 3.9 right now. So it's coming down. It's below the 4% mark that the 10-year, and seems like the big news this week is going to be the Fed. We have the Jackson Hole meeting, which is like the Davos for the central bankers. They all get together in Wyoming at Jackson Hole, and then he's going to give a speech on Friday. Jerome Powell, who's the chairman of the Federal Reserve, and he's going to let us know what he is thinking about doing with rates. It'll give us some idea. Are we getting 25 or are we getting 50? I think they are going to reduce rates in September. The question is how much. Right now, there's a 50-50 chance, a 50% chance they're going to do 0.5% reduction in interest rates, and there's a 50% chance they're going to do 0.25 or 1/4% reduction in interest rates. I think it's 25. As I've said since the beginning of the year, I think we get 3 interest rate reductions or 75 basis points this year. I think people got all excited a couple of weeks ago when the market went down, especially the Black Monday for Tokyo when it was down 12.5%. Everybody was running around. We need an emergency rate cut. We're going into a recession. Now we're coming back to, well, maybe we're not having a recession. I don't think so. I think the economy is doing okay. I talk about it in depth, Javed and I do, on the podcast today, so make sure you tune into that. Again, since in July, end of July to beginning of this month, the pullback that we saw in the market, technology without FANGs was down about 10. FANGs were down about 8.4. Russell was down 9.6. Regional banks down 10% on the pullback. Since then, FANG has come up more than what it went down. It went down 8.4, but then it's gone up more than that. It's gone up 10.8. FANG was down, FANG just by itself 10%. We've gained it all back. S&P was down 6.1. During that pullback, it's up 7.1 since then. The only thing, Russell, it's up 5%, but it was down nearly 10. So it did not come back up, the Russell 2000. That's the small cap index, as much as it went down. And that is a little bit of a disappointment, the way I look at it. Big economic data, inflation last week below the 3% mark, which is a good sign. Retail sales were good. So the consumer is still spending. It came out better than expected, which is a good sign, and that's why people say, oh, well, no recession. A week before they were talking about recession. I think, again, what the Fed does, inflation is now going to fall to the background. It's going to be how much the economy is slowing, and interest rates are going to come to the forefront, which is going to be the driver of the stock market. How much do the Fed cut? And that will be directly proportional to how much the market goes up. Looking at technicals, we gapped above right here. You can see last Thursday, there's a gap right there. The blue line is the 50-day moving average. We gapped above it. Looks like we're headed to new all-time highs. As I said, when we completed the fifth wave top, we get an A, B, C correction. This is A, this is B, this is C. Once we complete 5, that's when we get A, B, C. And then after that, we start the wave count to the upside. Wave 1, wave 2, wave 3, wave 4, and wave 5. That's how the markets move. Well, this is 1, 2 to the downside, 3 to the upside, 4 to the downside, and then the fifth wave top. That's Elliott wave analysis. That's how market moves. Once we get 5, then we get a pullback, and that's ABC correction. Question is, are we starting this new wave count to the upside? Is this wave 1? We don't know yet. We'll see what happens when we get to. But I think, again, we go back and forth. On the weeklies, you can see we completed 5 waves right here at the end of 2022. Then we came down into October of 2023, ABC correction. These are each one of these lines, green and red lines you see, is 1 week of trading. We had wave 1 to the upside, wave 2 to the downside. This is 2. 3 to the upside, and this is wave 4. But wave 4s are notorious for going back and forth for a period of time. So even though we came back here, bounced up, we go to new highs, then we completed wave 4. Until we get to new highs, we're still going back and forth. But you can see the projection now is coming in up to here for wave 5. After we complete 4, we should get wave 5 to the upside. And that is pointing somewhere around 6150. Again, this is a weekly chart. Could take a year and a half for us to get there, not right away. NASDAQ looks much better, but I'm still not quite convinced yet, even though we're above the 50-day now on the daily charts, looking much better. Came and tested the 200-day, didn't close below. It snapped right back above the 200-day moving average. But again, on the wave 5, seems like we've completed wave 5. Now maybe this is 3. If we go up to new highs, this might change to 3, and this might be wave 1, 2, 3. Then this is wave 4, and then we start wave 5. We'll have to wait and see, even though we're showing wave 5 here, but those are my thoughts, that this could turn into a wave 3, wave 4 correction on the weeklies, and be good. Go up to wave 5. Interest rates, they broke below this 4.8 number, which was last December. We got there in 1 day. That's August 5th when the market was down in Tokyo. But then we came right back above it. As long as we're holding somewhere around here, 4.25 to 3.8, just back and forth in that range, we're okay. Crude oil down big today on the thoughts that we might, the chances, the glimmer of hope is coming that we might get a ceasefire in Gaza, and that would be good for the world economy. It will be good for world peace, and it will be good, bring oil prices down. Small caps, again, disappointing. They came down, snapped back up, but nowhere close to the highs. I like to see it break above here. Eventually, I think 260 to 270 or 280 is the target, but will you make more money being in the S&P? Is it going to outperform the S&P, the small caps? We'll have to wait and see. Gold I like, especially the gold stocks. I talk about that in a lot more detail. Why I like, I'm starting to warm up to the gold stocks in quite more detail on the podcast, which of it, so make sure you tune into that. Those are my thoughts. Again, if you'd like to get help on your portfolio, give us a call at 800-388-9700, or you can just go to invest@compact.com. Drop us an email. We'll be more than happy to get in touch with you, develop a plan for you, and there's no cost or obligation. Those are my thoughts and observations. Again, if you'd like to get some more information, tune into the podcast or just give us a call. I will be back with you next week. Until then, good trading.
presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.